I'm here with Robert Zucaro today, and in the markets today, we've had a lot of volatility, a lot of change, and so Robert's going to give us an update to some comments that he recently made in a published article on value versus growth stock. Welcome to today's show, Robert.
Thank you, Alan. I have a couple of reports in my hand,
okay,
both disseminated in the past month. The first one is from Bank of America, which states value stocks will continue to be growth even after record outperformance in February. February clearly favored value stocks, as value stocks, according to the Russell ETFs, were up 9% and growth was up 1%. A second report in the Russell Investment Survey, the outlook states 2021 equities outlook, values time to shine. Now, both of the arguments from these sources which favor value stocks are predicated upon regression to the mean theory, because over the past 10 years, the growth style has far outperformed value. It is not regression to the mean that's going to determine the day as to which style outperforms, will be value or will be growth. I take the opposite view, and I think before the year is out, the growth style will again take the lead in the stock market. Here's why. I've looked at a number of value companies over the years, and companies such as American Airlines, United Airlines, Bank of America, Citicorp, Exxon, Chevron, and many of these companies, in fact, all of these 6 companies saw their earnings peak very many years ago. Citigroup last reported record earnings in 2005, Bank of America in 2006, Exxon and Chevron in 2011. And looking at peak earnings for all companies as a whole, which took place in 2019, before the pandemic took hold in early last year, every one of these companies was anywhere from 39 to 89% from its prior peak earnings. Earnings drive the stock market. There are any number of studies that have been done on this, including our own. For example, we subscribe to the dictum that price follows earnings. In my portfolios that I ran 1985 through the year 2000, for those companies that were able to produce earnings growth of at least 20% in any given year, the average price change was positive 62%. In the most recent work on our Golden Eagle strategy model, we segmented earnings growth over that 10-year period. For companies that improved their earnings by 20 to 49%, the average price gain was 36%. For those companies that improved their earnings by 50 to 99%, the average price change was higher at 56%. For the hyper-growth companies exhibiting earnings growth of 100% or greater, the return is at the highest, 81%. Now, whereas many value companies are up anywhere from 30 to 40 to 50% in the current year, their corresponding earnings growth is going to be much less than that, similar to overall profits growth of 22 to 25% this year. Meanwhile, growth companies continue to report record earnings year in and year out in many cases. So I think it won't be long before we see a return of the growth style leading the market once again.
Robert, in today's world, I've been reading different news releases, and of course, you got to be careful what you read, but there seems to be a common thread about the shift in the workforce, the baby boomers retiring. Some of these companies built up their empires on other people's time and other people's money. And then you have this new segment of the economy coming out with, leveraging on technology and AI. My question comes down to recently there was an article about gasoline shortages in this country, and they said it's not that there's not a supply of gas, it's that there's a shortage of delivery and logistical supply chains. When you're looking at the historical, the value stocks that have built up, take something like HP that, they have tens or hundreds of thousands of employees, but there's a shift in, how many of those are going to be retiring, and then what does the future look like? How much do you take that into account when forecasting, projecting earnings growth and doing value investing?
Well, Wall Street has a notorious record for forecasting earnings. There was a study done many years ago by Michael O'Higgins, who worked at the time as a broker First Albany. And he undertook a survey of 3,500 companies and the earnings estimates from 2,000 analysts. And he found on average that the actual earnings at year end deviated from the year beginning forecast by 50%. So it's very, very difficult to forecast.
Okay.
The vast majority of money managers use forecasting in their work. They use a fundamental approach. And the vast majority of funds have dramatically underperformed the market over the past 15 years. If you look at the S&P 500 versus active managers report as of mid-year 2020, they determined that 87% of all types of funds, small cap, mid cap, large cap, failed to keep pace with their respective benchmarks over the past 15 years. So forecasting, we know, is difficult. Now I'm going to approach this from a different way, Alan.
Thank you.
Recessions are absolutely vital to our economic system. Everybody hates them. And, when you're out of, somebody else is out of work, it's a recession. When you're out of work, it's depression. But without recessions, forcing businesses to become more efficient, reallocating resources away from inefficient areas to more efficient areas, our collective standard of living would not be what it is today. Let's take the pandemic. Everybody's concerned about the pandemic. We've lost a lot of lives. We've experienced, every one of us, disruption in our own personal lives. But 5 years from now, we will be looking at the pandemic as a seminal event in US economic history, because it is forcing on the American public and the American business establishment the same belt tightening measures that recessions impose upon us, and we're going to become more efficient. Many companies today have required their employees to be present on the premises because they felt that was positive. Well, when forced to work remotely from home, they found something very interesting in that productivity went up for two reasons. Number one, commutation time was filled by spending time on a job. Number two, spending time around the water cooler instead of being at your desk no longer exists. So the pandemic, short term, while it's been very damaging to society in many ways, long term, it's going to produce a positive stimulus for the US economy. And when the economy does well, so does the stock market.
When you look at the growth stocks for the future, do you see certain trends in areas of industries that look more attractive than others?
Well, we've undergone a sea change in the US economy. And the sea change really has to do with technology. As recently as 2010, that's only 11 years ago, there were only two companies among the top 5 S&P 500 companies that were tech companies, Apple and Microsoft, which comprised 4% of the overall weight of the index. Today, if you look at the top 5 in the S&P, everyone is a tech company, and they constitute an unprecedented 22% weight in the overall index. As technology continues to make inroads in our society, the collective economic of standard living is going to go up. What does technology mean? Technology means that companies can grow faster than ever before. Technology means that some companies can generate sales and profits growth of 100% or more. Let's take a look at a couple of prominent tech companies from two standpoints. One is revenues per employee. Google and Facebook have revenues per employee of 1.3 million and 1.5 million respectively. By comparison, General Motors has revenues per employee at 700,000. Home Depot has revenues per employee of 260,000. So technology allows business today to be more productive than ever before. The profit margins are far higher. The earnings grow faster. So you have a confluence of a perfect storm in the favor of improved corporate profitability.
So for the long term, in summary, when you're looking at value versus growth, you may see a pop in the short run in value, but growth is where to be in the long term. Is that your conclusion, or how would you say a long-term investor should position themselves today?
Okay. I don't think they're very well positioned because take the whole sandbox of technology, and you have two investment styles. Every tech company is going to be grouped into the growth nomenclature. The tech companies are growing faster. Many tech companies are producing record earnings year in and year out. I don't see how the value style can compete against a so-called runaway train. So I think this is a permanent thing. Now, for many years, myself, along with other investment sources, have advocated broad-based market indices like the S&P 500, the S&P mid cap, the S&P small cap, in order to get to three asset classes. I think today, this is going to sound heretical, but investors would be better off positioned in the NASDAQ, in the Qs, than the spiders, SPY, because the NASDAQ is going to far outpace the S&P over the next 10 years, as it has done over the previous 10 years. The Qs, which are the largest 100 NASDAQ companies over the past decade, have returned 537% compared to 267% for the S&P 500 spiders. I think what we're going to see over the next decade, Alan, is more of the same.
You know, when people are looking at benchmarks today, and of course they often use the S&P 500, but then there's others like the Russell 3000, the Russell 1000, and then they break that into segments of growth versus value. Where would you benchmark the performance of a growth fund today against which index?
Okay, it's a twofold answer. First, the granddaddy benchmark is the S&P 500.
Okay.
It's the universal benchmark, and you start with that. Secondly, you look at the specific styles themselves, evaluate growth versus value. It's very easy. The Russell has two ETFs, which are publicly available, and they have a 20-year track record, so they give you a reasonable backdrop on historic performance of the two styles.
Okay. So you're still a fan of the S&P 500 as a traditional benchmark for performance?
Yeah, I think everything revolves around the benchmark, but okay. Today, if I were to advise investors, I would advise them differently than others. I would say just buy the NASDAQ and ignore the S&P 500 because of the seismic shape in the economy and what's been transpiring with regard to the two investment styles over the past 10 years. You know, when you look at the statistics, and that's what I do as a fiduciary, I rely on facts and not opinions. And relying on facts has gotten me pretty far in the investment business.
So, Robert, your articles, your take on the market, I know you're published frequently, but if a person wants to follow you, how would they go ahead and do that? And also, I know you're a fund manager too, and they say, hey, Robert, make my life easy, you know, help me out and, you know, guide me through what's going on these turbulent times. So how would they reach you?
We've made it easy for investors and others in the audience. Simply go to targetqr.com. It contains, in addition to information on our strategy, but there are a number of topical commentaries and research studies on the website, which will be of use to all investors.
Okay, and when a person comes to you, they typically come through a broker, and is a managed account? Do they go for custodianship? How do they work through that?
Well, no, we're not in the brokerage community. We are a hedge fund,
Okay,
which limits us to a certain segment of the population, the more affluent. The view of the government agencies is that this should be limited in scope to that genre of investors, and justifiably so, because unlike with mutual funds, when you buy into a hedge fund, you innately will be assuming more risk. In the case of our strategy, yes, you're assuming more risk, but you're also getting a lot more reward based upon the way we do things.
okay. All right. Robert, I appreciate you being on today's show and for the update.
Thank you, Alan. Always a pleasure.